Yep, sure. As Ben mentioned, I am the solution architect. I have my hands in a fair bit of other functions as well, just because it makes sense from a tech perspective. In terms of the financial forecast, prior to getting down into the details of that, I just want to probably touch on the tech aspect of things, just taking you through the default rates, which is one of the main questions we get from investors or shareholders or anybody who wants to invest in Broly. That seems to be one of the main questions that are raised on how we handle default rates, how is it modeled, and how we have control of all of this. And so as part of that, I want to sort of firstly address how our portfolio allocation works in terms of funds coming into the platform, and how that then translates into default rates and sort of the outcome of that. That's one aspect I'll probably speak to in the first 10 minutes or so, and then move on to, I guess, the financial forecast. So done that for about roughly 5 years in terms of how numbers would look like with scale. And then finally touch on the unit economics aspect, so how the cost per user sort of tends to scale and tends to change with scale as well. And then we can have questions as well towards the end.
Yeah, sorry, Dinesh, just a quick one. When you cover off the default rates, could you just quickly maybe talk just very quickly about how your credit engine works in the initial verification process for the people when they lend?
Yep.
It'd be really good to understand how, because I notice, I know you guys have a credit agency behind this, so it'd be real good, interesting to see how that's picked up and how that works.
Yep, sure. So starting off, how does the fund allocation process work? So essentially, the question is, how do we allocate lender funds in Broly? So I assume you have the basic understanding of community lending and what Broly does. This is just going a bit more into the details of things. So when a lender contributes funds to Broly, we follow a sort of fixed allocation model to ensure capital is deployed in a way that we have control over. And there's a fair bit of reasons for this. But then what I want to touch on is what the distribution looks like. And so, for example, if we assume that a lender deposits 100,000, the funds are allocated across several products. So if you didn't know, we have products from $100 upwards to $2,000, 6 essentially. Yeah. So the pie chart on the right hand side, for instance, shows you the distribution across products. So if it's 100,000, 30% of it, so 30K, would be allocated to $100 products, as an example. And then going around on the pie chart, $200, it's around 18%, 400 around 25%, and then it sort of gets reduced when the amount goes up. Now, why this is done is this is based on our research, based on how buy now, pay later products works as well. And this is research done across Australia and the US on how this distribution looks like across buy now, pay later products and similar lending platforms as well. So this is what we've come to in terms of how we currently have things set up on the platform.
Yeah, I get it. You're managing your liquidity based on the overall size of the loan in case you're lender, in case you have a lender withdrawal, right?
Yes, yes. And moving on to the next slide, which is a detailed sort of example on how this works. So same example of 100,000 coming in, the diagram on the right hand side. So you can see the percentages there, the arrows there from 30% onwards for $100 products, 200, and so on. And essentially it translates into contracts, individual contracts. So $100 products would be $300 borrower contracts. So for 300 borrowers, we can facilitate contracts. And then going down the chain, it's 90 contracts for $200. Likewise, at the bottom, it's essentially only 2 contracts of $2,000 worth. Now, This is where we can probably touch on how the credit risk rating works as well. So essentially, when a borrower comes into the platform, what we do is we connect the borrower's bank onto the platform, and we actually get access to their financial transaction history. This is done via a platform called Basic, so that they are one of our partners. And essentially what we have is we have access to several months worth of financial transaction history, plus a lot of aggregate metrics that are given by Basic. So there's altogether around 4 to 6 metrics. So as an example, one of the things that we get is the average income per month over the last several months. So it gives us that value. And it also gives us the expenses, average expenses per month. It gives us metrics like gambling debt, or whether they have, how many times they've accessed their ATMs, to a variety of metrics, which we take into our risk engine. And then we sort of, we categorize them into 5 different very broad categories in terms of expenses, risk exposures, and so on and so forth. And then we come up with a score, essentially a score which dictates how much money they can borrow and what their risk sort of looks like. So essentially, based on these two values, we give an output saying, you know what, this person can only borrow up until 500 worth of products. So essentially what it would do is it would open up $400 products and maybe a $200 product and a $100 product. But combined, they can only borrow up to around $500. That's sort of the summary of how the risk engine works. And so far we've been testing the platform as well, and we have those dashboards in the next couple of slides. So I'll speak to it when we get there. But that is the essence of how our risk engine works. So currently, it's a combination of a statistical model plus a weighted model that we build in. But then the plan is to move on to a more machine learning type of model, which is probably a bit more flexible in terms of updating how it works over time, without getting into the technicalities of things. But then this is one of the key things that I've been working on. But yeah, that's sort of the summary of how that works. Essentially, then
a quick question, mate, does it also run a credit check with the credit agencies as well in terms of what previous defaults and the likes they've had and their credit history?
No, so that's not something that happens, purely because this is small lending, and doing essentially a credit check for high loans doesn't really translate into this as well. So that's something we've considered, but for the moment we haven't actually done that. Again, there is a potential that we may do that down the line if we increase the value of the product. So if it's not 2,000, let's say it's 10,000, we may actually do that. But for the moment, we don't.
I get it. Because what you're saying is you're accepting a level of default, right? Because of the loss is so small, right? And,
yes.
Otherwise, you're going to impinge on your margins on those lower level products if you were to run credit checks as well.
Exactly. And essentially, yes, going a bit deeper into all of this. So for $100 products, and there's a big, one of the things that we assume in this platform, and this is again based on the research that we've done, is that buy now, pay later products have a recurring rate of around 2 to 4 times on the platform of the lifetime of the user. So a user would use buy now, pay later products 3 or 4 times. So what we modeled in here is that for the lifetime of a user coming onto the platform, they would actually borrow it 3 times. So in some of the products, so let's say for $100 product, for us to actually get an income out of it, we expect a borrower to at least borrow it 2 to 3 times. that sort of is needed for us to gain a profit from that particular product. So again, based on how things scale, how things look, how the default rates look, we have the capability within the platform to actually change these parameters. So on the diagram on the right-hand side, if you can see, we've modeled default rates at 6% for $100 and $200 products, and going down to 2% for the highest product. So combined, though, we have it sitting around 3.5%. Now, why this is important is that these values, we've actually have it in the back end. What it means is, because we follow this allocation model in real time, we know whether we are going to hit these thresholds or not. So if we sort of exceed these thresholds, we have the capability to stop issuing those products. So as an example, for instance, if we hit the 6% defaults of the $100 products, and we know that we are going to exceed that, we actually have the capability to stop issuing those products. Essentially, so when a borrower who is only capable of borrowing $100 products, we would actually refuse them coming on the platform, saying that they don't have the sort of capability to borrow $100 products. So that's, in essence, how we have control over the default rates. This is again one of the main questions that is being asked of us, and this is sort of, and I think this is very different to how traditional lending works, because they don't really have a control over stopping this behavior, whereas for us in real time we actually have that capability to limit our risk exposure as well and have a better handle of things. So that's sort of the idea behind that. In terms of borrower contracts, so each and every one is a separate traceable legal agreement. It's again risk managed independently. And the overall allocation, again, is adjustable in real time, and it's based on the KPIs that we build in. So moving on to the KPIs, because it's one of the main points, I guess. So this is the diagram we have. I took this yesterday, so we currently have 103 total users on the platform, just hit 100 yesterday, 61 active lenders and 83 active borrowers. And this is essentially our main sort of operational KPI dashboard. We have active users, inactive active lenders, borrowers, and inactive lenders and borrowers as well, and then roughly the distribution between the two. Now, this sort of gives us the indication of how scaling sort of looks like. We also have performance KPI, so approval rates for borrowers and lenders. Currently, with our risk engine, we haven't implemented that because we wanted to get users in, but then the idea is to have it fluctuating between around 70% and 65% of an approval rate. So 100 people want to come into the platform, we only let 68% in. So it's just to ensure that our risk engine sort of follows that rule. So we don't essentially, the riskiest people don't actually get access to the platform. We have a similar approach for lenders as well. So based on their history, based on, because we do have, apart from basic, we actually have KYC checks as well. So based on all of this, we have an approval rate behind all of this. And again, we have churn rates included as well, just to track how many users actually leave the platform as well over time. This is again the most important dashboard for us, the financial KPI. So this gives us a quick view of the contract funds we have, and how much of it is in retail funds, how much is unused, and how much we have underwriting in terms of the contracts, how much is utilized, and the bad debt realized as well. So currently it's sitting at 0 because most of our contracts are still active. And then we, over time, will sort of have a gauge to how this looks like. In terms of, we also have, which is not included here, is the cost KPI. So we have a tech cost per user calculated behind the scenes as well. This essentially takes into account all of our partner costs and our cloud platform costs, just to give us an idea of where this sits with the number of users and then how it sort of scales over time. And that's sort of it with regards to the KPIs. Now, probably moving on to how our projections look like. Starting off end of year one, again, this is mostly based on how we expect our users to scale, which is directly proportional to how much money we intend on spending for marketing. Now, this is currently sitting at 72,000 users across the board, including borrowers and lenders. And as you can see, the gross interest earned by borrowers is around 3 million. So again, this is modeling this in terms of the lifetime earnings for borrowers, which is 3 times using the platform. 3 times, we sort of expect our gross interest to be around 3 million. So this is just removing the interest paid to lenders. And then we sort of have the rest of the costs here, which includes marketing, wages, the default funds as well. And then the accrued interest against our assurance account, which facilitates liquidity for lenders. So if lenders early exit and even the defaulted funds, we sort of we have it sitting there on the assurance account. So we have the accrued interest there, the technology costs, and then overall sort of the OPEX cost sits around 5.5 million. So altogether, the net earnings is minus 2.5 million for the first year. One thing to note here is the customer acquisition cost. We have it starting off around at $42 per user, and it reduces at 5% per month over each month, and then drops to around $16 by the end of the second year.
I'd imagine you're using something like Instagram or Facebook ads for this target audience. I assume it's a younger audience that would be in here. So in terms of your outreach and marketing awareness, you'd be mainly using those platforms. That would be the main target.
It's
maybe TikTok or something.
Yes, essentially it's digital marketing. I think there's a small portion for offline marketing on printed ads and so on. But essentially it's focused on Google ads, Facebook ads, all of the social media ads, and then SEO optimization and all of those. So yes, the demographic we are targeting is a young demographic. So it's mostly digital. There is a breakdown. I think we can share that at some point with you, James. It focuses on digital.
Yeah, that gut feel here, just on the side, is I don't know if I'd spend too much money on SEO here, because I don't know if you're going to get much organic traffic through that. I reckon it'll be digital driven through the social media channels. Sure. That's just my initial thoughts, right?
Yeah.
Yeah, absolutely. Look, we're going to be investing small amounts in finding out what works and what's most effective, and then before we start making more and more or bigger investments into those pathways.
Yeah, sounds good.
Okay, so moving on with the overall financial forecast we have. So this is across the first 5 years. So at the top, you can see the total active users. Initially, it's 70K, moving on to around 200K at the end of year 2, 4,500 end of year 3, around 800,000 on the end of year 4, and then 1.3 million end of year 5. So follows a similar structure. Lifetime earnings for borrowers goes from around 4 million upwards onto around 28, and the gross interest similarly, so 2.9 million up to around 19 million. What you can see at the bottom, the net earnings is minus 2.5 million, drops to around minus 1.7 million for the second year, and then post that it's sort of positive in terms of the net earnings. So 300,000 to 6 mil to 9 mil. This is sort of how we feel the numbers look like with the scale that we have. Again, one of the key
Is it sorry, mate? Is it all out of the Australian market, or have you got international?
This is just
just Australia.
All Australia.
Just
Okay.
Australia. You can imagine what this looks like once we introduce it to the UK market or
Yeah.
any bigger market. It just blows up.
Yeah, because I think I mentioned it to Ben, is this is a commoditized product. The more volume you can grow it, just the more money you guys are going to make. Obviously, you've got the liquidity pool risk there, but yeah,
absolutely. One of the key objectives, if we combine year 1 and 2, if we can achieve those 300,000 users within the first year or as soon as possible, really, and that's what 20 mil investment would, or any investment that we could get would inch us much closer, much faster to that objective. And if we can achieve that in year 1, that'd be freaking awesome. Year 2, we're essentially moving into profit mode. But the net is very conservative, which is, I'm the optimist, and the net is very conservative. But even if we land anywhere between, it's still a great achievement, even if we get there in 2 years.
So if I'm looking end of year 5, assuming that you have 3 transactions per customer, which is your modeling for your revenue scenario, some of those could happen in year 1, year 2, and then they could do one could be year 3, one could be year 4, one could be year 5. You're talking about having 600 or 700,000 active users in Australia. Does that type of volume exist in the non-bank sector?
You'd be surprised. There's an immediate target market of about 5 million, of which we sort of aim to achieve to get a portion of that. And even if the 1.3 in year 5 comes over time, that's neither sort of here or there for us. As long as we can get to profitability as soon as possible, that's the sort of key objective, and let us sustainably and organically grow from there. I do believe, right, again, the net's being very conservative, using other products metrics with 3 times a year use. We've got to keep in mind that this is a cash-based product. It's cash. It's not financed to a dress or a holiday, which like buy now later products sort of essentially offer. So I do believe the frequency of use is going to be a lot higher. But look, let's base it on the data that we have, and does that work? Which is what we've done.
Cool.
Okay, so I'll move on to the next slide. This is essentially the unit economics. So same sort of view, just from a user perspective of how much profit this translates per user. So the lifetime earnings per user, as you can see, it sort of tends to go down with the scale. So the earnings per user again reduces, but the net profit, because the marketing costs are significantly higher per user, because the CAC sits at a very high level, that really goes down over time. So from $41 to around 14 to around 6. Same thing with OPEX costs, and even bad debt translated per user, it tends to go down slightly. So overall, it sort of goes from around minus $26 per user. So we lose around $26 per user to around $2.50 to being positive $5.2 per user at the end of year 3. Sorry, I've lost the year headings here, but then this is year 1, year 2, end of year 3. This is again just to have an idea in terms of how it looks like per user. It gives us sort of the visibility, especially around tech costs as well, how this translates over time and how much that cost would then be reduced over time. Moving on, sort of the key assumptions that we have. So I think I've sort of touched on all of this. So this is, again, using 100% utilization of funds by the borrowers on a 30-day borrower cycle. So we assume that the borrower sort of halves, they only return the money after close to the 30-day cycle. It's not returned early, so there's no earnings we can have post that. Approval rates around 68% sitting for new borrowers, and 90% for lenders. So 90% of the lenders would be approved onto the platform. Default rates from 6% to 2% at this point in time. So these are the numbers that actually translates into that financial forecast. 3% churn rate has been modeled in as well. So across the board for borrowers and lenders, so 3% would be leaving the platform. The CAC starts off around 52 and then drops to around 16 by the end of year 2. Operational overhead costs includes a fully funded team. So we are the existing development team we have offshore. They are still with us, and we assume that they would be, and some of the additional resources that we would need over time are included. Bad debt recovery is again not included in this per cost, because it's actually really hard to assume what that cost would look like, or whether it's actually a viable thing to do, because the amounts are very low. It may not be feasible to actually get that in. So we haven't modeled that in to the financial forecast. And yeah, that's sort of it on what I wanted to present. Happy to take more questions. Are there any?
That was really good. Thanks, Dineth. That's answered a lot of my questions, actually, from having spoken to Ben and the team, and then read through the docs and watched the pitch deck and YouTube video. So I think that's really, really useful. Thank you.
No problem. Any more questions? Ben, Nadun, anything to add?
No, I'm good, to be honest. Ben.
Rich, did you have any questions? It's the first time for you seeing this as well.
Can I ask Dineth to go back to the setup costs, the capital you guys need? Because I think that's the purpose of today's meeting, has it been?
Correct.
Yeah. No, keep going back. Oh, is that it? Yeah, that's it there.
This one.
So, Dineth, maybe the question is, if we had $20 million available to us under whatever structure it ends up being, where's that going to go and why?
All right. Yeah. So in terms of how that looks like, so if you look at the first 2 columns, this is essentially assuming that we would sort of hit within the first, depending on, let's assume that this is 2 years, we would sort of reach 200K. The cost for achieving that is sort of the sum of these 2 values. So it's around 13 mil that is required for us to scale to 200K. Again, if we put in more money, it means that we have more money which we can allocate for marketing. So essentially this value here, the 6 million, can go up, which directly translates into the number of users coming onto the platform. Again, end of year 2, we are looking at a minus 4 mil overall, but it helps us scale to 200K users, and post that we sort of have positive revenue and profit coming in as well. So how I would see 20 million being used, again, it's essentially from a bulk perspective, that's how it's going to look like. It is stage-wise approach, obviously. So marketing costs, again, initially it's going to be a larger amount starting off, and then over time it tapers down. That's how it's built in as well. So it reduces 10% each month, but then I've sort of modeled in a fair bit of assumptions in there that we would, or we at the start of each year, we sort of put in additional amounts just to ensure that we have sort of a stable marketing cost model in. But yeah, that's roughly in terms of whether you want to see it as 1 year where we want to reach 200K, or within the next 2 years we want to reach 200K. Roughly the cost would be around 15 to 20 million is what I would see being needed to actually achieve that target.
Okay.
So if we can achieve that, essentially we've dominated the Australian market, right? And there's plenty of opportunities once we've got that ecosystem under our control to start introducing other products, but none of this modeling is factoring any of those opportunities.
Yeah.
This is purely based on just the one product offering. And we can imagine what the value would be of the company even at just this point. And look, forget going overseas. If we just were to base it just on the value of the company, if we achieve this just in Australia.
Yeah. So in terms of now, you guys need money for operating costs, right?
Correct.
And you need funds in terms of effectively what you talk about, that assurance piece, right? Effectively your liquidity backstop, right? You need access to some type of funding, right?
Correct.
And then is there a need for temporary credit to effectively undertake retail operation until you can attract the right number of investors, or will those grow together? You know what I'm saying?
Do you mean like if we received a smaller amount to gain a bit further traction in data while we're raising a large amount? Or is that?
So if you went out and spent 100 grand on marketing and bought in, I don't know, 500 to 1,000 users, right? In terms of lenders, you would have to match that, but more than 34% more, because you lend 68 or 70%, I can't remember what the exact number was, of the retail investors to the lenders, to the borrowers, sorry.
Oh, yeah. I think what he's meaning to net, and correct me if I'm wrong, James, is if we've got X amount, 100 grand in retail funds being lent out, that we want to have a portion of the total funds that are being lent essentially sitting in the assurance account for liquidity purposes. So, you know, we're being very conservative at the start. We're working on a basically one-to-one. But as we sort of grow and we start to get data, you know, we may be more comfortable to go to 50% of the overall pool, you know, down to 30. Then our credit line requirement on a percentage basis of the total pool will reduce to what we actually need based on historical data.
You'll have actual real life modeling of what your defaults look like and your investor withdrawal.
May work out to be that based on the data, we've got $10 million of loans out there in any month, right? That we never see more than 20% or being utilized in the assurance pool. So we'll just stick $2 million there just in case.
So James, based on what we've seen so far, that's so initial assumption was it would probably sit around 30% of the contract funds to support lender liquidity, so lenders leaving the platform early. Having said that, with the 100 odd users, and I know this is a very, very, very small sample size, we've hardly seen anybody leaving the platform. And I'm not really sure why that is. Maybe it's because, again, these are currently, it's very small amounts. So lenders, what we encourage lenders to do is putting their extra cash into the platform if they have it, so that they can earn interest. So it may be that we don't have a lot of early exits. Again, data would sort of help us over time to actually come up with a very realistic estimate. But I suspect it sits between 30 and 50% of the total contract funds, no more than that, which should facilitate the early exits or the default rates, or whichever way you want to say it. It's that's sort of where things are. But then more data would help us get a better idea of how this works. But that's where it's currently sitting.
Hey, James, this is just my guess, but I think that people are not pulling their funds out because they know if they do, they're going to lose that 20% per annum return. So unless extenuating circumstances, I do believe liquidity broken contracts are going to be fairly low. But that's just my guess. I believe time will prove the obvious.
Yeah, I'd agree with you, mate. I would agree. And you guarantee their funds too, don't you?
Correct.
You guarantee that if I put money with you, you will there's defaults, my funding's guaranteed, right? Well, as much as you can that the company solve them, right?
Correct.
Which is why you need the insurance.
The company remains solvent, and ultimately,
Yeah.
what that comes down to, the only thing that's going to break the company is if we don't manage the defaults, right? And so we are obsessive about that to make sure, as the net has sort of gone through, to ensure that it remains below those thresholds, you know. But we have very tight controls over being able to manage that.
So you guys are effectively ready to go now, right? You're just ready to scale. You just need
We're ready, James. We just need money.
you need the money to do the marketing, to match the borrowers to the lenders, and to do that you need two streams of financing, right? One is the operating capital.
Yep.
Yeah. So you keep you guys going for the next 6 months or something at least, right?
Yep.
And then you need funding, and this is where I don't understand. So help me here. Is
Yep.
it to fund the assurance pool, or is it to do the assurance pool and to provide lending as well, because you haven't been able to get enough lenders on board versus the number of borrowers that you would get? So you've got a shortfall in the borrowers versus.
Yeah, so the assurance pool or liquidity account covers three core functions, right?
Yeah.
Liquidity for the lenders who want to pull their funds out. So
Yeah.
Whether that funds comes in as equity in which we put it into that account, or if that fund comes through as a credit facility and we put it into that account, doesn't matter, either or. But the second purpose is liquidity for the lenders, and when we've got peak borrower demand. So retail lenders aren't keeping up at that moment in time. We're never going to have perfect parity, right?
Yeah.
Just to ensure that the borrower's demands are getting met, right? Then we'll step in as the lender in that instance.
Yeah. So that's where you'll take the full ARR of 60%.
Yeah.
Right?
So it's a cash cow, that assurance account, right?
Yeah.
Because it's taking the full ARR on that borrower contract.
Yeah.
It's even more of a cash cow for lenders who decide midway through that they want to break their contract, right? And let's say day 15 comes, they decide they want to pull their funds out, $1,000 out for whatever reason. We step in, take over that contract, and we take the full interest on that contract for half the amount of period. So our ARR actually doubles on every one of those contracts that we take over from a lender that wants to break them. So, like, people sort of see it as a negative, right? But it's a cash-making machine, that assurance account, and it's what also enables us to help covering the cost of interest to whatever the facility that comes into play.
Yeah. So I think what you need, and I know you've sent me through a document which was real useful, actually, Ben. I think what you need is you need a mezzanine facility where you have access to a credit facility or the assurance pool. I mean, you don't really want to be giving away equity for an assurance pool, right? For liquidity, it just doesn't make a lot of sense for you guys, right?
Yeah,
that's just my take. I mean, it's something I'll probably look at. And then you would want some equity component to fund the growth of the business, right?
Yeah.
So that is the marketing, wages, technology costs, core IP stuff, right? That's the way I would.
Yeah.
That's the way I would approach this, because you just dilute yourself to the heavens if you started, because you've got a timing issue in your collection of funds. At some stage, you'll have enough resources where you'll regret giving away equity for the assurance pool, right?
Yeah. In an ideal world, you're absolutely right, James. Like, if we could separate those two issues, then great. But if in the short term we had to top up the assurance account to kick the can a little bit further down the road, right, to prove to the credit provider, and give them a bit more data, then so be it. That's what we have to do. Just ultimately, one thing we can't do is stop the growth. Right, the growth is occurring, and we need to keep it going. because that also has a negative effect too.
So when your valuation of the business is roughly 10 million, how are you going to raise 10 times 1 million packages when that's pretty much all your equity, isn't it?
If we're looking at a straight equity scenario, and this is why I've kind of mentioned the sort of safe note options, it enables both the potential investors coming in to look, when it's going to be very hard for us, and we're going to continue to debate forever about what the valuation isn't, and what's it going to be. With the safe note structure, we can basically decide that we both know this is going to grow, right? To what it's going to grow to, we don't know yet, but let's just agree to move forward, and then we'll convert that to equity in the next round. And all we're really negotiating is what's the discount on the equity at the next round, whatever that may be.
Yeah. So you're literally, you've got a convertible note there, right? At some point in the future, a number of things determine at what point that vests and how it's valued, right? No, I understand.
Yeah.
I understand what you're doing there. It's a traditional convertible note setup.
So So their protection is natural downside protection. If we raise capital at a $20 million valuation and they've put in $20 million, well, they've got 100% ownership of the company, which
that's the bit I was worried about.
So look, we believe it's going to be anywhere between, it's going to be a couple of $100 million,
So Ben, I know that you got your preference in Nadine. I know your guys' preference is to not have any one investor that has more than $1 million commitment, right? I know that's the preference, and I understand why. But as I mentioned to you, all of my investment pool, the people, all my VC people and PE, I've only got really one company that would be interested in the deal, because they're quite happy in that Series A, Series B, or even not quite pre-seed stage, but that kind of series maybe C level, early stage, but with high tech, high potential, right? So there's a bit of risk there. But I mean, trying to get $1 million out of them, it's too much of an effort for them to just do $1 million, because they've got to put the same amount of effort whether they do $1 million or $5 million. So, I mean, I could approach them, and then we could put it in where you guys can sit and go, well, actually, this deal's pretty good. We like these people, and maybe we'll be a bit flexible on that. Or my other suggestion is to you, and what I talked about is we run an outreach campaign through LinkedIn, and we identify high net worth individuals, probably maybe 20 or 30 of them over the next 3 months. We approach them and target them specifically in a targeted outreach to get 3 or 4 or 5 or 10 $1 million investors, right? That's the other way to do it, because there'll be a lot of people, high net worth people, that will have a pretty diverse portfolio, and somewhere in that portfolio allocation there'll be a 5% or 7% that they have for very high risk projects where they expect high returns, but they're happy to take that risk. Do you know what I mean?
Look, we all options have to be on the table.
Yeah.
And all offers need to be considered. So, if the one you mentioned that could potentially put in the 20 mil is fair and reasonable, there's no reason for us not to do business. So if they're there, let's definitely let's bring them to the table. I've done the LinkedIn outreach. LinkedIn has just become even worse than email spam, and to be honest with you, it's virtually a waste of time. So it's really more of a case of who do we know? Who do you know that trust you, your decision, and know that you've gone through it, and more than happy to go through it with them as well. And let's just try and make a deal done.
So are you guys comfortable if I approach my investor in Sydney that specialises in early tech companies?
Yeah.
I mean, they would. There's no way they'll do 20 million, but they won't probably do less than 3. Do you know what I mean?
Yeah. So
That would be a good cornerstone investment, wouldn't it?
yeah, absolutely. And as I sort of suggested, that any amount of capital that we get in, we can work with. Any structure that they want, we can, virtually work with. You want a straight equity, you want to do a safe note, you want to do debt. We've got the capacity, our platform, to generate revenue. So we're comfortable with debt. So it's really a case of what do they want, right? And how much do they want to invest? And we can definitely come up with something that works for both parties. What we don't have is the luxury of time.
No. And then what I'll do is I'll go back quickly through my credit providers and see if there's anyone there I think that could be interested in this because of the return.
Yep.
And it might be one of those ones where they just strip feed, right? They just strip feed into the assurance pool.
Yeah, absolutely.
Guarantee it, right?
No, absolutely. We don't want $5-10 million for no reason. As long as we've got a line of credit to it, we can call upon it maybe 100,000 at a time or $1 million at a time. And we can pay a coupon rate as it's needed.
That sounds like a sensible approach, hey? Okay. I feel pretty comfortable with everything now. I think I understand everything pretty good. So it's very poor English. I think I understand everything pretty well. And I think the other stuff you sent me through, Ben, I think I'm probably in a position now to start doing a little bit of outreach myself and talking to a couple of people and see what I can pull together, right?
Oh, awesome.
Right. Was that what you were looking for me for today, Ben?
We just love to share the news about Brolly to anyone that would love to listen. And if you can contribute and add value and participate and be part of the team. Awesome.
Totally. Absolutely. Yeah. And we'll have a conversation about that because you guys are a big junior anyway. Once you start getting some traction on this, it's going to just skyrocket off.
We need a lot of expertise in various areas, and my goal is not just Australia, it's just get Australia done, hurry up, and let's get to Canada, where hopefully Rich can help us, and go UK or Saudi, where I'm speaking to a few others.
Yeah, sounds good. Hey, good one. And Denise, that was a good presentation. Thanks so much for your time, and nice to meet you, Nadine and Rich. So, yeah.
Thank you, man.
You guys all on LinkedIn?
Yeah, we're on LinkedIn.
Yes.
All right. Well, I'll stalk you out and send you an invite. Hey.
Oh, sure. Definitely, man.
Thanks so much.
All right.
Speak
Awesome.
soon.
Talk to you soon.
James.
Thank you, guys. Cheers.
Bye.